Today, I am going to share with you why, in my opinion, I believe that we need to see a Bitcoin crash, a complete collapse in the crypto space before we can see Bitcoin and other crypto assets reach new all-time highs. Before I begin, understand nothing that I am saying in this video should be taken as financial advice. I am simply sharing with you my thoughts and my opinion. Now, in today's video, we're going to talk about why I feel we need a crash. We're also going to cover some past crashes that has happened in the Bitcoin space. We're going to talk about how you should be positioning your portfolio going forward. We're going to be talking about dollar cost averaging, and we're also going to cover the stock to flow model and how it's been accurately predicting future Bitcoin prices. Now, why do I feel that we need to see a crash in the Bitcoin space and in the crypto space in general? Very simple. When have you ever seen Wall Street allow Main Street investors to dump their bags on them? It just doesn't happen. Most of the time, Wall Street's in early. They get into the investments early through venture capital, etc. And then they pump the price up. They take a company public, etc. And they dump on you. Well, we know that the entire crypto space mainly is a retail phenomenon. And we also understand that Wall Street is coming to the party late. So I believe what we're going to see is we're going to see a crash, and you shouldn't be afraid of a crash. Bitcoin is a highly speculative and a highly volatile asset. And understand it can go up 30% and it can go down 100%. And I'm going to show you that now. What you should be focusing on is dollar cost averaging and allocating your capital over time. So now what we're looking at, it says visualizing all horrific Bitcoin crashes. So we're going to go over some of these crashes. As you can see, on January 12th, 2012, we've seen a crash from $7.38 all the way down to $3.80. That's a 49% crash. We've seen Bitcoin crash on August 17th, 2012, from $16.41 down to $7.10. We've seen Bitcoin go from 49.17 down to 33. We've seen it go from 76.91 down to $50.09. This was back in 2013. We've seen an 83% drop from $259.34 down to $45. We've seen another 50% correction. We've seen an 87% correction, right? We've recently seen a 70% correction. Now, understand, depending on which exchange you look at, the prices vary because different exchanges have different prices. So you have Coinbase, they may have a quote at, for example, 7,150, and you may go to Kraken, they may be at 7,155. That's just the spread, that's arbitrage. But you can see Bitcoin has a history of huge booms and huge busts. So you should not be afraid of that. Now, what I'm going to do is I'm going to read you an older article. It says 5 big Bitcoin crashes and what we learned. This article is from September 18th, 2017. And again, all the link to all of these articles are going to be in the description below. Let me just zoom in a little bit so we can see that a little bit better. So the article starts off by saying, September has been a wild ride for Bitcoin owners. The digital currency began the month nudging an all-time high of 5,000 before losing nearly 40% of its value in a spectacular crash. Now, a recovery has seen Bitcoin pop back over 4,000 as of Monday. So now let's look at some of these breakdowns that we've had in the Bitcoin price. The meltdown of April 2013. You can see here's the chart right here. It says what happened. In the spring of 2013, a ghastly collapse saw the price of Bitcoin fall from $233 to $67 overnight. That's a 71% drop. It would take 7 months to recover. Understand, so we've seen these big drops before, but if you're properly allocating your capital, you won't have that problem. It says, what happened? The crash of April 2013 came after Bitcoin's first big brush with the mainstream. The currency had never crossed $30 before 2013, but a flood of media coverage helped drive it well above 200. The crash, which followed 2 smaller jolts in March, reflected in part a correction to spectacular exuberance. Some also attribute it to an outage at Mt. Gox. the popular at the time exchange for buying and selling Bitcoin. Here we go again. Pop goes the bubble in 2013. What happened? Bitcoin spent most of the rest of 2013 around $120. Then prices jumped tenfold in the fall. Bitcoin hit an all-time high of $1,150 in late November, and then the party ended abruptly and prices tumbled below 500 by mid-December. It would take more than 4 years for Bitcoin to reach $1,000 again. So again, this article will be in the description below, as well as this previous article I was showing you with the crashes. Now I want to just currently show you Bitcoin's price right now so you can see what's happening with the price before we get into balancing your portfolio and properly allocating your assets and dollar cost averaging. So you can see this is recently at the beginning of this year where this was the high of the year. I think this is what, around like 14,000. Again, on different exchanges, you're going to have different prices. Some may say 13,900 and some change. Others may say 14,000. It all depends on which exchange you're looking at. But you can see we peaked out here and then we began to go into this downtrend. And we had these retracements where we retraced here. Let's zoom in a little bit so we can see a little bit better. Give me 1 second. So you can see, and we retraced, brushed up against the trend line. We pushed back down. Give me 1 second. Let's move this. Brushed up against the trend line again, rejected it. And as you can see here, so we're in somewhat of a downtrend, and we've been defending this 6,500 level. Buyer stepped in, pushed the price up. This was the China pump. Understand Bitcoin, because it's speculative in nature, it's very easy for news to get people excited to see exchanges pump the price. So this was when China came out and said they're going to be open to blockchain technology. And then after 3 days, they came out and said, yeah, but it's going to be a private blockchain. We know China is all about censoring its citizens. They would never adopt technology like Bitcoin because it's censorship resistant. But that's a separate video. And then we can see we've sold off. And now we've seen, we're right here. Let's zoom in. And you can see we're right here in this area. I believe that we're going to break down to around this $4,000, $5,000 range where we broke out from earlier last year. It was this April. Actually, this is this year. April of this year where we broke out from. I believe that we're going to break down into that region again, see a lot of pressure selling, and that's where I'm looking to be a buyer. So I'm looking to be a buyer above 8,000, and I'm looking to be a buyer in that 6,000 range. I'm scooping up as much Bitcoin as I can in the 6,000s, the 5,000s, and the 4,000s, which leads me to my next point, again, which is dollar cost averaging. Think of dollar cost averaging like this. I buy one Bitcoin at 10, right? And I buy another Bitcoin at $5. So now it crashed from 10 all the way down to 5. I buy one at 10. I buy one at 5. My average price is going to be 7.5. Why is that? You're going to take 10 and you're going to add 5. And then you're going to divide it by 2 because you own 2 units. And then you divide that, which gives you 7.5. So dollar cost averaging allows you to allocate your capital over time. So therefore, you're not going to just take a 50% loss, right? Because think about it. If you take all of your money and you buy it at 15 and it crashes down to 10, or you buy it at 10 and it crashes down to 5, you're down 50%, right? But if you average and you properly allocate your money the right way, you buy one at 10, you buy one at 5, now you have an average price of 7.5. So what I do is every week I buy $200, $300, $400 worth of Bitcoin. That's what you should be thinking about doing if you're looking to get into the Bitcoin crypto space. It doesn't make sense to go all in because those people who went all in here, if you go back to the chart, the people who went all in at 14,000, well, they basically lost 50% of their money, right? Because it crashed from 14 down to 7. But if they would have been averaging, buying a little bit over time, because see, I have a 3 to 5 year window with crypto because I understand that Bitcoin is a hedge against the financial system. When I look at Bitcoin this way. When you see most commodities, they are the inverse of the US dollar. If the dollar goes up, commodities go down. The dollar goes down, commodities go up. This has an inverse relationship. It has a correlation. When you look at Bitcoin, it's not correlated to any other asset. It's new. And when you understand that Bitcoin is deflationary in nature, you're going to understand exactly what I'm talking about. So I encourage you to go and read this. I'll briefly read the first passage for you. It says, dollar cost averaging is the strategy of spreading out your stock or fund purchases, buying at regular intervals and in roughly equal amounts. As I said, buy one at 10, buy one at 5, divide it, that gives you 7.5. When done properly, it can have significant benefits for your portfolio. This is because dollar cost averaging smooths your purchase price over time and helps ensure that you're not dumping all of your money in at the high point for prices, as I just showed you. Dollar cost averaging can be especially powerful in bear markets, allowing you to buy the dips or purchase stock at low points when most investors are too afraid to buy. Committing to this strategy means you will be investing when the market or stock is down, and that's when investors score the best deals. As we went back, remember, if you brought at $45, you're laughing when it pops up to 75. You buy at 378, you're laughing when it pops up to 1,163. See, most people, they chase investments. They buy as it's going up. People like Warren Buffett and smart, intelligent investors, they wait for the crash to happen when people are fearful, and that's when they're willing to go out and buy. Which leads me to my next point about balancing your portfolio. Let's say you have $50,000 or $100,000 to invest, not at one time, but over the course of the next 3, 4, 5 years. You have that kind of capital that's going to be at your disposal. Well, the younger you are, the more risky you could be. You can invest in highly speculative things like Bitcoin. The older you are, you kind of want to balance your portfolio for more fixed income, things like real estate, cash flow, mutual funds, bonds, etc. So for me, being that I'm young, I'm 60% heavily invested into speculative things like medical marijuana, silver mining stocks, gold mining stocks, and different cryptocurrency projects. And as of today, there's over 3,000 different cryptocurrencies. I mainly just focus on the top cryptos because I feel like that's where my capital is the safest and it has the most liquidity and they have the network effect. But I digress. If you're older, you're going to probably have more of a 80-20 portfolio where 80% in a fixed income, like, fixed income assets, and 20% is going to be in speculative things. So what I would be doing, as I said before, I'm more like a 50-50 or 60-40, the younger you are, into highly speculative things. If you're older, maybe you may want to be more, 70-30, 80-20. Again, this isn't financial advice. This is something that you have to think of as far as to what you want to put your money in. Now, let's kind of dive into that a little bit. If you put your money into real estate, you know you're going to have a mortgage. If you have a mortgage, let's say hypothetical, you know that you're going to get a tenant in there. The tenant's going to pay, you're going to charge them enough rent to pay the mortgage, to pay the taxes, to pay the insurance, and then what's ever left over, that's going to be your profit. That's fixed income, right? Because you know it's a fixed dollar amount that you're going to be receiving. Versus with Bitcoin, because it's so volatile, you could be down 30% for the next 6 months, and then boom, you 2x your money, you 3x your money, you 5x your money, right? So when I'm trying to invest in cryptocurrency projects, I understand the risk that I'm taking because we're going through what is known as price discovery right now in many of these crypto assets. So just keep that in the back of your mind when you're allocating capital and balancing your portfolio. You should not have 100% of your money in Bitcoin, and you should be dollar cost averaging. So if I have $10,000 or $5,000 to invest, I'm buying $200 here on this dip, $100 here on that dip, $500 here on that dip. I'm not just going to take my whole, my entire portfolio and all my money and dump it into Bitcoin. Because as I said before, there's over 3,000 different cryptocurrencies. Find the crypto project that works for you. Now, the next thing I want to show you is the stock to flow model. And this is exactly why I personally feel that we just need to see this crash. The stock to flow model was created by Plan B. This is his Twitter over here. I encourage you to go and follow him. This is a beautiful model. This model simply takes the stock, the current circulation of whatever investment you're trying to invest in, and it looks at the flow, meaning the new production or the new amount of that particular asset that's being created. So for example, when we look at the stock to flow, we look at gold, for example. We look at all of the gold that's currently in circulation, and then we look at the production of gold, that's the flow, and we just simply divide the flow by the production, and that gives us different numbers. Now, I want to go to this article right here because this article sums this up beautifully. Give me 1 second, right? So we're looking at the stock to flow ratio for gold. And what makes gold money is the fact that when you divide the flow, right, new Bitcoin, not Bitcoin, new gold that's being created, the production, versus what's in stock, 185 tons, you begin to see that it would take 62 years of current production to total the entire supply of gold today. Now, because of that, it has a stock to flow ratio of 62. As you can see here, they have silver. Silver has a stock to flow of 22 because that means it simply would take 22 years of current production to equal the amount of silver that's currently exists today. That's what makes money important, right? There's currency, that's fiat, and then there's money. Gold and silver is considered money because it's hard to create new gold. It's hard to, you can't, first of all, you can't create it. It's hard to find new gold. That's the same thing with Bitcoin. Now, what makes Bitcoin so powerful is the fact that number one, Bitcoin has a fixed cap. There will never be more than 21 million Bitcoin. That is programmed into the code. Also, every 4 years, we have something known as a halving because there's a Bitcoin subsidy in every new block that's created. First, it starts at a 50, then 4 years goes by, then the subsidies cut down to 25, then the subsidies cut down to 12 and a half, then the subsidy gets cut down to 6.2, and so on and so on and so on. And what the stock to flow model does is it tracks all of the halvings. So you can begin to see that this next halving, Bitcoin's current stock to flow, remember, new production, new coins is being produced divided by the old stockpile. Bitcoin's current stock to flow ratio is 27, around what silver is. This next halving, because there's going to be less new Bitcoin being created, right? That means the production's going down. We know that the supply is not going to increase. They're predicting that we should be up here in the $100,000 price range. Now, again, obviously, this is not going to happen overnight. The next halving is going to happen, I think, May 1st, 2020. And then the next one is going to be 2024, et cetera, et cetera. So you have to have a long-term window when you're looking at this asset. And I don't want to get too technical and dive into, how new blocks are created every 10 minutes and stuff like that, because I understand that for some of you, this is new. So I try to keep things simple, surface level, give you some information that you can go and look. So when we start actually, just pulling away some of these things, you can see the upper end of the model is when Bitcoin's overbought, and then we have the lower end where Bitcoin's oversold. So you can see at times we will revert away from the mean. We'll be overbought, and then we'll come back down, and we'll be oversold. And currently we was oversold here, and then we push back up, and this is where we're currently at. And you can see up here also we were overbought, but we came back down to the mean. So all of the links for these things, all of the links for these articles, for the stock to flow model, for the medium article, dollar cost averaging, all of these things will be in the description. But again, it's extremely important that you understand this is why Bitcoin is so powerful, because when these halvings happen, the stock to flow ratio goes higher. So when this next halving happens, like I said, Bitcoin's currently at 27. Bitcoin's going to be at 52 when this next halving happens. And then after that, it's going to be in the hundreds. So now that means that the stock to flow ratio is going to be higher than 62. So if gold has a multi-trillion-dollar market cap, follow me here, a multi-trillion-dollar market cap, and it has a stock to flow ratio of 62. And now we're talking about Bitcoin because it's deflationary in nature, because you have to factor in people losing their private keys. You have to factor in each halving event that happens. That means that there's going to be less new Bitcoin being created, so production's going down, and then people are losing, so the actual supply is going down as well. So Bitcoin's going to capture some of that gold market. And if Bitcoin currently has a market cap of 125, 127 billion, I haven't checked recently. Matter of fact, give me 1 second. Let me just pull that up so I can be accurate and give you accurate information. Let's see what the actual Market cap of Bitcoin is? Yeah. The market cap of Bitcoin as of today is $134 billion. Now, I just told you gold is a multi-trillion-dollar market cap. So as Bitcoin begins to rise, as it becomes more and more mainstream, as less and less new Bitcoin are being created, you could begin to see where the price can go in the future. So you have to have a long-term thesis as to why you're investing and looking to hold Bitcoin. You should not be holding your Bitcoin in exchanges. I had a video where I explained to you what a hardware wallet is and why you should be getting one. Buy your Bitcoin. Again, if it's $100 a week, if it's $500 a week, if it's $500 a month, understand why you're investing, understand you're holding this for the long haul, and understand the power of this technology. And if you don't understand, take your time, do your due diligence. So with that being said, thank you for watching this video. Please do me a favor. If you enjoyed this content and you're not subscribed to the channel, subscribe and hit the notification bell, like this video, and share this video. Have a great day.